This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and make profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 199. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rcraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the microcap message. Last week, we just announced the initial presenting companies for the SNN Network Canada virtual event, which is happening December 7 through 9, 2021. Please go to canada.snn.network to see the full list of issuers that will be joining us. Paul Andriola from Small Cap Discoveries and myself on behalf of SNN Network are teaming up again to highlight our neighbors to the north, Canada. In the last 5 to 10 years, small, micro, and nano cap investors have been finding value accretive opportunities on the TSX, TSX Ventures, CSE, and NEO. So we wanted to have an event to highlight everything available there. So you can expect 3 days of keynotes, educational panels, company presentations, and one-on-one meetings. To register, please go to canada.snn.network and click the register button. We look forward to seeing you there. Now, for this episode of the Planet MicroCap Podcast, I spoke with Luis Sanchez, investor and founder of LVS Advisory. I was introduced to him by Ben Claremon, host of the Compounders Podcast. Thank you, Ben. This is the first time I met with Luis, and we chatted about a whole host of topics. His defensive portfolio strategy focused on merger arbitrages, growth portfolio philosophy, naked wines thesis, value traps, and more. I really enjoyed meeting Luis and learning more about his investing approach. Thank you again for tuning in to episode 199 of the Planet MicroCap Podcast, and please enjoy my conversation with Luis Sanchez. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me today is Luis Sanchez. He's the investor founder at LVS Advisory. I was introduced to Luis via Ben Claremon. Shout out to Ben, the host of the Compounders, the Anatomy of a Multi-Bagger podcast. I invite you all to go check out the weekly wrap-up that we just put out there. But the task at hand today is getting to know Luis even better as a person, as an investor. Luis, thank you for joining me today. How are you doing?
Hey, Bobby. I'm doing well. Thank you so much for having me. I look forward to doing the pod.
It's great to have you on. And for those who are listening to the audio version and not watching this on YouTube, Luis happens to be an expert botanist based on his background. I need to get some tips on how I can take care of my plants a little bit better. I mean, my money tree's doing okay here, but I don't have a green thumb.
Rare plants have been an incredibly high-performing investment asset class for me. They pay for themselves. You cut the leaves, and you have some natural compounded growth right there.
Fair enough. I mean, look, it's not artwork anymore. NFTs. You know, we're talking rare plants. Like, this is going to be a whole new asset class that everybody is going to overlook. Clearly.
Yeah. And I'm only slightly joking about that. You could go Google the rare plant boom, and it's actually been another really interesting asset speculation bubble.
Wait a second. So what's the most popular rare plant right now?
Oh, well, it changes. It actually changes by the season. So I think the way the rare plant ecosystem works is people will breed new, what do you call them? Like crossbreeding different strains of plants and like coming out like new
phenotypes or something? Like,
I can't remember the technical terms, but then what will happen is like a plant will basically go viral on Instagram because someone created like a leaf with like an interesting hue, and then people will start buying it like crazy and bid up the price of that plant. They'll buy it and then they'll resell it on like Facebook groups or on eBay, or I think there's some plant specific platforms. And then what happens is once a plant gets really popular and big, then like the Home Depots and Lowe's of the world mass produce them, and then the prices plummet. But every season there's like a couple of like types of plants or breeds of plants that get really hot, and people will pay thousands of dollars just for like little cuttings of like monsteras and Hoyas and all sorts of interesting rare plants.
Dude, I thought I heard it all, but wow. Here, I know we have a lot more to get into today, but I almost want to stay on this for a second because I've never ever had even in passing conversation about the rare.
I think you're gonna have to do your next podcast interview with my wife, because she's the master horticulturist.
Listen, my dad has a green thumb. I think right now he is like frothing at the bit hearing that we're talking about rare plants on Planet MicroCap right now, and is like taking notes as we speak as to where he can find all the information he can on some of these rare plants. So, oh man, all right, we'll come back to rare. We'll come back to rare plants at the very end. Dad, I'm sorry. Don't worry. We'll get into it later. So, again, this is our first time actually meeting together, even though we were introduced from Ben. So to start off, I'd love to hear about where your passion for investing began, and then we'll go from there.
Yeah, for sure. So, honestly, a little bit later than some other folks, I learned about investing in college. I didn't even know what a stock was probably before college. I initially wanted to go into some kind of international trade or international business, and I was a dual Chinese language major and business major. And in like one of these intro to finance classes, we did a stock market, like in-class stock market game. And I'm a fairly competitive person, so I wanted to win the game. And I started learning about, it basically forced me to learn about how the stock market worked and like try to figure out what stocks would outperform. And I was hooked. After that, I pursued a couple of internships. I had the opportunity to intern with my university's college endowment, where I was able to listen in on that. I went to Florida State University, and Florida State's endowments invested in some world-class hedge funds and private equity funds. And I interned basically right after the financial crisis, and I was able to listen in on all of like the quarterly calls and hear like these hedge fund managers and like private equity fund managers talk about how they were navigating the post-crisis situation. And it was super fascinating. And it really inspired me I really wanted to learn a lot more about what they were talking about. And it really inspired me to like pursue that career. I had that initial hook from the intro to finance class, but once I had that internship, I knew I wanted to do that as a career. And I did a few other internships in asset management, but after college, I decided to go into investment banking. I spent the first 5 years of my career in various like sell side roles. The last role I was in was at Credit Suisse's M&A team, where I was actually on the hostile M&A desk. And it was a really interesting situation. It was a really interesting position because we were working on like the most, the hairiest deals, right? We were on the other side of the table with like really well-known activist investors. We were helping companies pursue hostile takeovers. So it was a unique situation because I was able to like learn about a lot of the non-quantitative aspects of special situations. So like the legal and structural corporate defenses, what goes into like a shareholder vote, what the role of like ISS or Glass Lewis is, and different things about the regulatory process. And it was a really interesting experience. And it was the initial seed that led me to start LVS a few years later. And I'll get back to why that's important. But right after Credit Suisse, I joined a startup quantitative firm where I joined basically this quantitative firm that was pre-launch, and I was like a junior founding partner. And we pursued a quantamental strategy, which was trying to take the best of like fundamental quantitative value investing, but have like a human overlay. And I was essentially like the human overlay, and my partner was the quant who was administering and programming the algorithms that we were using to basically pick the stocks. It was a really interesting process. Joining a firm pre-launch, staying on post-launch, helping to raise money, helping to like design different elements of not just like the portfolio and stock selection process, but also just like how to run the business and how to like interface with all the different parties involved. A few years into that, I got this idea to start a new investment strategy that was actually more of a qualitative strategy. It wasn't a strategy that made a lot of sense to administer quantitatively. And basically the idea was to create a merger arbitrage strategy. And so that's like the connection with like Credit Suisse and like my experience in M&A is ever since I worked in M&A, I always continue to follow different M&A situations. And in my personal portfolio, I started investing in different deals that I thought were interesting that had attractive risk arbitrage spreads. And in 2018, I had a pretty interesting realization, because 2018 was a year where at the start of the year, we had the volatility crash, which led to a correction in the stock market. And then towards the end of 2018, the Fed started raising rates and the market corrected 20%. And when I looked at how my like merger arbitrage portfolio was doing, I was putting up a double-digit return with almost no volatility and no correlation to those crash events. And I thought there might be something there. I thought it was actually a pretty compelling, it could be a pretty compelling investment strategy to pursue. And, after I separated from the quantitative firm, I spent a few months, putting together what I thought the portfolio could look like and learning a little bit more about merger arbitrage. In early 2019, I approached some initial investors, and I launched basically LVS Advisory with the single strategy of running this merger arbitrage portfolio. And the idea behind it, or at least the way that I describe it to folks, is, we focus on the less risky merger arbitrage spread. So we avoid the situations that are like truly the hairiest. So the ones where there's like a coin flip chance of getting regulatory approval or getting shareholder vote approval. We focus in on like the ones that are highly likely to close, but still have an attractive premium. And I've been running that strategy for 3 years, and we've effectively been able to put up a double-digit net return with fairly low volatility. So it has actually performed the way I thought it would perform, and it's just continued to be an interesting strategy to run.
So Luis, let me stop you there real quick, because we'll get into that in a second. So when you had this idea for the strategy, but you're still working at this quantum fund, so what inspired you then to be like, all right, I'm good. I think I feel ready. I feel that I can do this. What was that impetus then that said, all right, great work in here. I want to go start my own shop?
Yeah, I mean, a lot of it is personal. A lot of it is just that, there's something a little bit different about starting your own firm and, just kind of being fully in charge of the decision-making process. Part of it too was just that I thought that I had a unique insight into a niche, and I didn't really see another way. I didn't really see other people pursuing the strategy the way that I had thought it through. And I thought there was an opportunity not just to launch an interesting strategy, but to basically offer it in a low friction way, right? So like through separately managed accounts and without like very onerous terms, because merger arbitrage isn't a new strategy. It's just difficult to access.
No, fair enough. So okay, this ties in.
And I
now.
guess I would add that like the process of working at a startup fund and going through that pre-launch process and post-launch process, I did learn a lot about that process of running the business, which gave me a little bit more confidence to strike out on my own.
Gotcha. Okay. So now let's get into that investing approach. You sent me your investor deck prior to our chat today, and you have you have three. You have the defensive portfolio strategy, your growth portfolio strategy, and then kind of the combo of both. So I want to dig into first your defensive portfolio strategy, because it sounds like that ties in mostly with the merger arbitrage thesis. So let's dig into that. What exactly is it? How do you, as you say, get access to some of these merger arbitrage opportunities that maybe other folks that are employing that strategy or want to employ that strategy, where there's that I guess that barrier to entry?
Yeah. So I think that there is limited understanding of the merger arbitrage opportunity, and also some potential barriers to entry just due to some of the specialized knowledge required to kind of understand the nuances of deals and like how to understand how to read and successfully invest in the right deals.
Hey, Luis, actually, so you know what? This is actually a good question. Maybe we should probably answer that first before we even get into the approach. For those that don't know, what is a merger arbitrage opportunity? Let's define that, and then we'll get into the investing approach.
Yeah, absolutely. So merger arbitrage is simply like when company A, let's say, buys company B for a certain price, let's say $10 a share, but company B trades for $9 a share. If you buy company B at $9 a share and the deal closes and you receive $10 a share, you lock in an 11% return, right? And the idea is really that as long as the deal closes, you get paid and you earn your return, regardless of what happens in the economy, regardless of what happens with interest rates. But granted, there are barriers to getting the deal closed, so there is risk, right? So that's why merger arbitrage is generally referred to as risk arbitrage, because it's not a true arbitrage. It's not free money. There is still risk involved. Where I think a lot of the focus, there's a lot of different flavors of merger arbitrage, and within my merger arbitrage portfolio, I actually pursue like a few different like sub strategies within it. I think a lot of folks are familiar with the idea of, you can go long a target and you can short the acquirer, and you can play both sides of a spread. That makes sense in like a stock transaction, like a merger of equals. Where I've really focused in on initially was all cash deals, because I view all cash deals as basically like a zero coupon bond, right? So that's where I can really kind of bank on getting a fixed return that I could model an IRR for, as long as I kind of get a sense for, if I have confidence around when a deal is going to close, I could model a discrete IRR, and I could just make a judgment of, is this return attractive? Is this IRR worth the risk of the deal not closing, right? And essentially, when I construct my portfolio, I'm investing in typically 20 to 40 different merger arbitrage situations, or sometimes other special situations with similar characteristics. And I could get into that as well. Like we've actually expanded beyond merger arbitrage. Just to give you some examples, in 2020, we got really big into like buying SPACs at discounts to NAV right before SPACs went crazy. And then we liquidated the portfolio when our SPACs were at premium to NAV. We've also participated in buying preferred stock below par value when we think that the market may have misunderstood or wrongly sold down a preferred share. I think there were a lot of really interesting preferred share opportunities in the COVID crash. Today, we actually have pivoted back to merger arb because there's a lot of opportunity now because with the new administration, a lot of folks are worried about the regulatory risk. And, I think with rising interest rates, people are also in some cases worried about the financing risk. So that's actually made merger arbitrage attractive again. But going back to the idea of portfolio construction, when I'm putting together the portfolio, it's essentially a series of like 20 to 40 idiosyncratic bets, right? Where the risk in any one of those positions is fairly isolated, right? Because it's usually, a regulator might not like a particular deal, or or shareholders might not think a particular deal is attractive and might not vote in favor of it, right? So that's where the correlation to other types of asset classes gets really interesting. And what you tend to see, and I've read a lot of academic research on the merger arbitrage premium. Historically, the merger arbitrage spread has been in the neighborhood of 300 to 600 basis points above treasuries over the last 40, 50 years. That's actually a really similar range as high yield bonds, right? It's a similar return spread range as high yield bonds. However, high yield bonds have much higher correlation to what happens in the equity market. And whereas the merger arb spread really isn't correlated that much to anything, what you do find and what people do get worried about is when you have these these financial crisis scenarios and a bunch of deals start falling apart, there is some correlation at that point in the cycle, right? But during the rest of the cycle, there's virtually no correlation. And so so I think there's a lot of interesting things about it. And I think it's kind of overlooked as an asset class is the long short of it.
No, 100%. I mean, I think some folks probably listen to this, and especially for me, I'm about to ask the damn question, but when it comes to looking for and sourcing acquisition targets for potential investment, or just to understand, how do you go about finding the ones that you think, all right, this could be an acquisition target? And also, do you have some sort of allocation for when maybe a deal pops up and you can quickly move on it? Or first part of the question first, and then maybe the second part.
Yeah. So as I was mentioning before, there's a lot of different ways to, I guess, invest in this ecosystem of opportunities. Some investors like to speculate pre-deal on situations that they think a target could be acquired. Other investors like to focus on deals that are really hairy, where there's a really big spread, but there's also a really big risk of a deal not closing. I'm pretty strictly focused on deals that have already been announced or are highly likely to be announced. So there is some kind of process ongoing. And I'm mostly focused on all cash deals, but I do dabble in some stock and cash deals when I think the risk return is adequately compensated. And there are some other flavors. I do like to speculate on situations that I like to refer to as limited downside but potential upside. So a go shop process, or a situation where there's a lot of contingent consideration, like a CVR, but maybe so I'll just give you an example, right?
I was just gonna go there. It's example time. Let's go.
Yeah, I'll just give you and I won't necessarily name specific companies here just for simplicity. But theoretically, there's a company that it's been announced they're gonna be acquired by company A, and the market is basically, and if you read if you go through the terms of the merger, they've agreed to let the target go through what's called a go shop process, right? Where and what a go shop process means is, yeah, sure, the company has a definitive agreement to be acquired by the company that just agreed to acquire them. But there's this optionality that they could go out and they have permission for a limited amount of time to go out and seek other offers, right? So they typically hire a third-party investment bank, and they'll go around and basically, this is especially the case when like there hasn't been a very robust merger process, a robust sale process heading into a deal. So if a deal happened really quickly and like the board says, oh, okay, like in order for us to like feel that we've adequately done our job as the board, we need to make sure that we've carried out a fair process. And when these situations happen, it could be interesting to like study the target a little bit and to really think through, okay, how likely or how attractive is the current deal, and how likely is it that a higher bid could emerge, right? And this is where like having spent some time in like merger arb land, you tend to know like which type of assets are maybe hot and which type of companies have been the subject of like target speculation in the past. And if a deal didn't go, if a company didn't get acquired by the company that people thought it was going to get acquired by, all of a sudden, there could be speculation that, okay, maybe this other company that everyone always thought was a clear strategic fit could actually come in and make a higher bid, right? So I refer to that as like a limited downside, but potential interesting upside, because oftentimes these deals, I mean, the market is somewhat efficient. You don't get a very attractive merger arb spread. You might only get like a 1% spread or like a 0.5% spread. But, if you buy into that deal below the price, below the initial offer price, obviously the worst case scenario is the deal falls through to begin with. But the more likely downside scenario is you don't lose money. You just basically have a lower return. But it does open up the possibility to having, a potential 10, 15, sometimes 50 to 100% upside opportunity in the case of a bidding war. And it's happened a few times, and we've been lucky enough to participate in some of them. And that's just like another, and by the way, that's just another example of something that's just completely uncorrelated to anything that happens in the day-to-day happenings of like the stock market, right? So that's why I really find this asset class to be very interesting and attractive, because there's a lot of idiosyncratic and definable risk that you can take. And, the upside is actually fairly reasonable if you pick your spots, right? Like if you can consistently generate a double-digit return, even, without using leverage, I would argue that you could match or you could get close to stock market returns with significantly less risk over time.
Got it. So I'd love to hear, if you'd be willing, I'd love to hear an anecdote or a story of you deploying this strategy and that, whether it worked out well or not, but would love to hear a story that maybe you learned the most from, or you had was just a fun, interesting, reason why you love this strategy.
Yeah, it's tough because, we'll get to this in a minute, but I also invest in on the growth equity side and compounders. And, the work we do on the compounder side tends to be a lot more memorable because the companies and the stories that we learn about are more interesting. Whereas like we invest in in the 3 years that I started running this strategy, we've done hundreds of merger arb deals. And like they all kind of sound like the same after a while, right? It's like, this spread was decent. This situation didn't work out because shareholders voted against it. This situation was interesting because we got a surprise higher bid, or, China came in and blocked the deal. Like, I guess like the war stories I have, because it's what merger arb ends up looking a lot more like is it ends up looking a lot more like bond investing, where you tend to learn what to avoid. And that's how you do better, is you avoid. It's like what Howard Marks refers to in a negative art, right? Like you tend to know that, okay, a semiconductor deal that requires China approval, that may be involved in like national defense is probably not probably has a lower probability of getting all the approvals it needs, right? Or like one situation I'll tell you about is like in the past I used to invest in some utility M&A situations, and I learned after investing in one or two of these utility M&A situations that there's so many like local and state approvals that can happen, that the process usually drags on way longer than you think, and it requires a lot more monitoring from the portfolio manager to follow the regulatory approval state by state, where it's just like, okay, unless the spread is like particularly appealing, I tend to avoid stuff like that, right? And I've, one time I invested in a company that was listed on NASDAQ, but it was domiciled in Israel. And when the deal closed, I had to do a whole bunch of paperwork to avoid paying like a really large Israeli excise tax or withholding tax. And you learn about these things later. It's like, oh, okay, maybe that's why people didn't want to buy this deal, because there's a whole bunch of paperwork on the back end. And it's like, look, okay, we made our money, the deal closed, but we had to jump through a few more hoops for this one. So I tend to, as I've like gotten involved in more situations, you tend to learn what to avoid and what's a greater hassle. And my strategy really with the defensive portfolio is rule number one, don't lose money. Rule number two, try to generate an attractive return. When investors come to me and they say, hey, I want to like make a lot of money, and I'm okay taking risk, I don't tell them to invest in my defensive portfolio. I tell them, okay, like I have a growth portfolio where we take more risk and we try to earn higher returns. The defensive portfolio is really designed to be more like a high yield bond product that's just uncorrelated to other products, right? We're really just trying to do like a high single digit, low double digit net return per year, and generate a more consistent return.
Very good. All right, so I think we probably closed the book there on the defensive strategy. But we were talking offline when we were talking about your other strategy, the growth portfolio one, and you had a pretty funny story about having started it when you did, and continuing on with it since then. So you want to kind of give a little background there, and we'll get
into it. So it's actually kind of interesting. Like, I started the defensive strategy because I thought it was a differentiated and unique strategy that I think was appealing to a certain type of investor. And one of the things I realized when I started raising money for it was, it does appeal to a certain type of investor, but it doesn't appeal to every investor. And, you do have some investors who, want to take on more risk and are really more focused on return maximization. And the other thing I always thought about, even from day one with the defensive strategy, is one of the things that the defensive strategy does really well is protect our capital during a downturn, right? And I always thought like, okay, but when we do get a downturn and there is like a really good drawdown in the stock market, that might actually be the time to redeploy the capital in the defensive to something else to take advantage of that opportunity. And I wanted to have like a vehicle to basically have I wanted to have a vehicle to take advantage of like a correction in the stock market, right? So that's initially what led me to starting the growth strategy. And, in addition to that, I would say that I've been very fascinated with growth and compounder type investing ever since I was in college. I think well before I started LVS, I've published compounder ideas on like websites like SumZero or Value Investors Club. And, I think there's probably a presentation you could find that I put together for the Sohn Idea Conference a few years ago. It's always been something that I found fascinating and an interesting way to invest. But it's also something that a lot of other people pursue. So it's not as differentiated as the defensive. But I effectively, 2 years into LVS, I decided that I had enough. I was good enough at managing the defensive. I had gotten that down to a process to where I felt comfortable launching a second strategy on top of that, which was the growth. And I worked on putting together the portfolio, the day one portfolio for the growth strategy for, about a year leading up to that. And what the growth strategy is, it's a 15 to 20 name best ideas portfolio. And really, like, if the idea of my defensive strategy is like, we want to earn a decent return and we don't want to lose money, the growth is like the exact inverse of that. Is we want to just make as much money as possible, and we're going to take risk. We're going to go anywhere. We're open to anything, right? So that mentality has taken us to U.S. microcaps. It's taken us to foreign microcaps. It's given us some like interesting sector concentration in like the areas of, the market that we think are the most interesting long term. It's an anything goes portfolio. It's literally, let me find the 20 stocks I think we're going to make the most money on over the next 5 to 10 years. And day one launch was January 1st, 2020. And I launched, I raised some money for that. And then January was a good month. February was starting to be a good month, and then COVID happened, and we immediately went into like a 30% drawdown with the market. And I was beating myself up. I was like, oh my God, did I just like launch, a high beta strategy at like effectively the worst time to launch a high beta strategy? But but it ended up being the last, 2 years have ended up being a pretty good time to be a growth investor. And we tend to invest in like higher quality names, the type of companies that actually performed well during 2020. So we own a lot of software companies. We own a lot of internet platforms. We own a lot of like capital like compounders that are, even like real world physical asset capital like compounders. And like that 30% drawdown quickly turned into better performance. But it was a really interesting year to launch a growth strategy. One actually interesting aspect to running both a defensive strategy and the growth strategy is I was actually alerted pretty early that the COVID crash was coming due to activity I saw in the defensive portfolio. So because a lot of the deals that I invested on the merger arb side are financed with high yield debt, I pay really close attention to what goes on in the high yield debt financing market. And in early to mid February, I started to see the signs that some of those deals were not going to be financed. And it really led me to asking questions around, okay, like, is something bigger going on here? And in late February, so heading in like the day one portfolio of growth, we had a couple of names that were travel exposed. We owned TransDime. I think we owned Booking. And I actually, ahead of, in that last week of February, I was starting to really get worried about COVID because of what I was seeing on the high yield bond side. And it got me alerted to, what was underpinning that move. And it actually led me to trade out some of those names ahead of that crash, which actually ended up saving us some money in terms of not losing money on some names that were like highly levered or travel exposed in the growth portfolio. So there's an interesting connection there. But yeah, 2020 was interesting, and the environment for growth continues to be interesting. Actually, I'm finding a lot of like really in this post-COVID environment where value has started to outperform growth and a lot of the COVID beneficiaries have sold off. I'm starting to find a lot of really interesting babies that have been thrown out the bathwater over the last 6 months. So I'm actually getting really constructive for how the next couple of years are going to look.
Let's go down that rabbit hole before we get into maybe some of the case studies that you put into the deck. What are some things that you're seeing, in terms of, when you're looking at a little bit more longer term?
Yeah, for sure. I mean, I'll start with one that's in the case study. Like, I think Naked Wine right now is really interesting. And Naked Wine's a stock that I discovered summer of 2020. Someone reached out to me and said, "Hey, like, have you heard of this company? They just did a really interesting business transformation. They used to be a physical wine retailer in the UK with like this online distribution point, and they got rid of basically all of the physical assets. They sold the physical business to, I think, a private equity firm, and then the business just became this online wine selling platform." And I was like, okay, it's really interesting. By the time I found Naked Wine, it had run up a little bit from, what was happening with the lockdowns, but, it still was really clear to me that there was a lot of value left in the stock. I mean, this is a company that when I found it was like a sub 300 million pound market cap trading in the backwater of the LSE, in the AIM exchange. And, actually one of the many arbitrages that I've kind of been obsessed with in the growth portfolio is finding companies that trade outside of the US, that if you just relist them to the US, they would immediately trade at a higher multiple. And in particular, I really like companies that not only is that the case, but it also happens to be the case that their largest geographic segment is the US. So that's Naked Wine, right? Like 50% of their revenue comes from the US. They trade in London. They trade for about 1 times revenue. Where if you look at similar subscription model businesses in the US, they trade anywhere from like 2 to 4 times revenue. And I mean, similarly, you could see a similar disparity if you look at it on a price to gross profit basis, or like a price to normalized EBIT basis. But, I found this company, and, when I look for companies on the growth side, I know historically, like value investors, the margin of safety is usually the price you pay. But I guess the way that I learned how to invest, and the way I learned how to invest in a way that works for me, is I actually like to invert it. My margin of safety is the quality of the business that I own. And price just happens to be what I'm able to get it for. And, I try not to overpay, but my margin of safety is really finding a really high quality business that I'd be willing to buy more of at a lower price, right? So I'm very much, and that's all to say that I'm very much qualitatively focused, especially when I'm first learning about a business, right? So, I found this company, someone hinted me that this could be an interesting company, and I joined the wine club. I spent like 6 months as a subscriber, and I love the product, and I don't even really like wine that much. And, as I was studying the ecosystem that they're involved in, a lot of the pieces aligned. Like, even going back several decades, direct to consumer wine has been like a double-digit growth industry for decades. Since Naked Wine has launched, it's gained market share every single year. One of the things that we saw during COVID was obviously an acceleration of that trend. But not only was there an acceleration in terms of the amount of customers they were acquiring, what Naked Wine does is they have a two-sided marketplace where they own exclusive, they own the winery, basically. They own this exclusive vintages. They own these exclusive vintages of wine, and they have these really great relationships with winemakers. And yeah, they also own the consumer relationship. And, that's where they add value by connecting these two sides. And sure, for the consumers, Naked Wine was solving a really important problem during the shutdown, which was, okay, we can't go to bars and restaurants. I guess we have to, and maybe we don't want to go inside of a liquor store. Let's order wine online. But they also solved a huge problem for the winemaker, right? Where the winemaker, all of a sudden, where the largest end market for selling your wine is selling to restaurants, and selling to those channels where consumers used to consume, that all got disrupted during COVID. So what Naked Wine was able to do actually was significantly improve the caliber of its winemakers that it recruited during COVID, because all of a sudden, winemakers were not in a very good position with the shutdowns. And Naked Wine comes by and says, hey, like, we can solve your business model problem. We can give you guaranteed demand. We can pre-fund your working capital needs. All you got to do is focus on one, which is what you want to do. And, you may even make more money with us because we have such a large platform, right? So, thinking through, I guess, like the positive impacts of, the surplus they're creating on both sides of their, two-sided network, I thought, okay, like this is really interesting. And, participating with the product as a consumer and just seeing like, how great the user interface was, how much I really enjoyed learning about the winemakers and, the curation process of like the platform starting to recommend bottles of wine that you might like just based on your other purchases. I was like, okay, like this is like a really compelling platform. And on top of that, if you look at the structure of the industry, Naked Wine has actually become the largest player in DTC wine. And there's something like 3 or 4x the size of the next largest player. So they're also starting to really benefit from economies of scale. So there's some really interesting sustainable competitive advantages. And yeah, sure, Naked Wine is not a company that everyone's heard of, but it's a company that's actually starting to it's in the earlier phases of really building out its moat and, really establishing its brand value, right? So that was a lot of what underpinned my initial investment. And, it's been, and we still own the stock, full disclosure. It's been a good performing stock. And now what we've seen in this post-COVID, in this post-COVID sell-off market, is the stock has come down a bit. It's come down, I think it's in like a 15 to 20% drawdown. And a lot of it makes sense, right? Because, there's supply chain issues. And if you think about what the business model is, one of Naked Wine's largest frictions in their cost structure is like using the logistics, like paying for logistics. And, Q3 and Q4 of 2021, Naked Wine is likely getting, we'll find out really soon when they give us a trading update, but it's very likely getting raped by logistics costs, which is, caused the stock to come down a bit. And, people are also worried about what's going to happen when people normalize after COVID, or people are going to start going back to restaurants and turn off the service. But, for me, when I look at that, and if I see the stock come back down materially on what I would argue to be, shorter term worries, like that's when I start to get excited about, reloading, buying more stock, getting loaded up for the long term. Because if I just look at what's, the arc of what's happened over the last 10 to 20 years in DTC wine, and it, and I think the future probably looks like a continuation of that trend, I get really excited about where Naked Wine's going to be in 5 to 10 years if it can continue executing the way it has.
Very good. Okay, so that was a very clear example of of your growth strategy and looking for these compounders. I mean, is there any nuance, would you say, to that strategy when, especially in these post-COVID times? I mean, you mentioned it a little bit here with, you're seeing a very short-term issue that is for mainly the reason why the stock maybe took a little bit of a hit. But I mean, is there anything else that in terms of what we're seeing right now from a macro perspective that is causing you to say, okay, that's why there are still more interesting opportunities out there, or more reasons to maybe reload in some names that you like?
Yeah, I mean, look, I try to react to macro and I try not to predict macro. I try to understand what's happening in real time so I can get a sense of like, what does this mean for, business owners and people who are making business decisions today. It's really clear that, it's hard to really generalize, but I would say that there's a lot of companies that I would argue fit the mold of being a high quality, whether it's a tech-enabled platform or, just a company that really benefited from COVID. A lot of these companies were pushed up to really high valuations, circa January, February of 2021. And we're seeing 50, 60% drawdowns in some of these names. And it gets to a point where you have to wonder, okay, maybe I missed it. Maybe I missed the initial move, but at what point does the valuation start to get attractive again if I still think that, the longer term outlook is positive, right? And, certainly there's a lot of push and pull between what aspects of COVID was a temporary, demand driver and what aspects of it were an accelerant, right? I think the video game ecosystem is another really good example of that phenomenon where, like, yeah, sure, when you're stuck at home, you play more video games and you probably spend a lot more money on video games. And when you go outside again, when you stop locking yourself up at home, you're probably going to play less video games and spend less on video games. But what a lot of those habits that you develop during COVID, they don't die easily. And look, it's happened to me, like, personally, right? Like, I started to play some video games over the pandemic, having not played for like 10 plus years. And now I still find myself playing some games from time to time. And so, like, that idea of something becoming an accelerant, and now there's a higher plateau from which you can grow from, it's really hard to judge. So, and I'm trying to think of another good example, but I think I'm seeing similar patterns. Whether it's online gambling, or whether it's playing video games, or whether it's ordering things DTC online, people are becoming habituated to new ways of doing things. And some of those people will go back to the old way of doing things, but some of those people have realized, oh, actually, this new way of doing things is actually really convenient. And maybe I even save money, or I have a better user experience, or, I get more utility out of it for whatever reason. I'm going to keep doing it even when we go back to the old way of doing things. Right.
Mm-hmm. Right. So I actually want to do a quick pivot back to, the defensive strategy. And, you said you looked at a few indicators that actually told you, oh, wait, this COVID thing might actually be very real, and it gave you a signal into, some of the names that you had in the growth strategy. But I mean, look, the talking heads on the mainstream media networks are, everyone's kind of thinking like, all right, hey, there might, everyone's kind of looking over their shoulder for, potential, drawdown, potential recession. I mean, in some of the things that you look at, I know I sound like one of those talking heads now asking you this question, but I mean, why not? Let's go there. I mean, is there anything that you're seeing that signals anything like that to you, and why things are kind of shifting more to value versus growth?
Oh, you mean like current indicators?
Yeah, current indicators.
So look, I'll tell you, like, the indicators I saw, February of March 2020. I mean, as a starting point, the merger arb spreads themselves were good proxies for what was happening in the bond market, right? The deals that were reliant on high yield bond financing were selling off, and I was trying to figure out what it meant, and if it was a good buying opportunity, or if it signaling something deeper. The real insight came when I went a layer deeper, and I looked at the spread in the high yield bond market. So I think if you could look this up, but it's publicly available on Fred. And, there's a normal range for, like, the spreads that you would expect high yield bonds to be over treasuries. But then when the spreads blow out, right? So I think a normal range is somewhere in like what I said earlier, like a 300 to 600 basis point range. But when the spreads blow out, like, let's say 1,000 basis points or greater, that usually signals like full on panic, right? And one of the things I was doing, in February of 2020 was every day I was looking at the high yield bond spread, and I was seeing it widen and widen and widen. And then I was hearing of, okay, Corona is spreading to this country and that country, and now it's in Europe. And I was like, okay, the bond market's really worried about this. Even if COVID doesn't end up being, like this, 1913 pandemic or 1917 pandemic, it clearly is going to impact the economy, whether it's people just correcting their own behavior. And look, and you could also, there's also things you could look at with, like, the VIX index, and, something that a VIX trader tuned me to was, like, looking at the spread between the short-term VIX futures and the longer-term VIX futures, right? So there's all these types of, like, spreads that are, like, really sensitive to like economic happenings, right? And I'll be honest with you, like when I look at those indicators, and I do look at those indicators whenever we have sell-offs. We've had a few like mini corrections in the past year, post the 2020 bear market, and those indicators have all been fairly healthy like ever since. So I'm not seeing that. And what, like you see, there's a lot of noisy data, right? Like with inflation right now is one that people are particularly paying attention to, and there's all sorts of different ways to slice and dice that data. And I'm not going to sit here and give you a strong argument either way, but it's just worth watching what happens with these indicators that people are focused on, and just really deciding, okay, like, is this a short-term issue? Is this a long-term issue? If it is a long-term issue, what does this mean for my companies? I would argue for a company like Naked Wine, if logistics prices and energy costs go up, like they're going to be able to pass off at least some of that to their customer. There is some pricing power there, right? Whereas, let's just say a utility company, like a straight up, energy producer, they're not able to pass on inflation as quickly, right? Because they're regulated. They have to get approval to increase their rates, and they're going to eat the rising costs immediately, and they're going to benefit from price increases later, right? So there's certain business models that are just a little bit more resilient to different environments. So I just I try to figure out what the risks seem to be, and I just try to make sure that if these risks get more acute, that it's not going to necessarily be a situation that spirals out of control for the companies we own. So, very specifically in March 2020, I sold TransDigm because it's travel related, but really I was more worried about the debt load that they had, right? They were highly levered, and they were, exposed to they just did like a levered recap right before the March meltdown. And I was like, okay. And they did a levered recap, and I think they did a pretty big acquisition the year before. So I was like, okay, like this balance sheet is not a balance sheet that people are going to want to own heading into this, all things being equal. And then on top of that, the fundamentals of their business could be impaired, at least in the next 1 to 2 years. So that's kind of how I looked at that, right? Whereas, I look at Naked Wine, and it's like, okay, one aspect of their business is under pressure. It's highly debatable how I would argue that the acute part of that supply chain issue is already passed. And one of the things that I've been monitoring with Naked Wine is social media posts, and you could actually see people have complained like, oh, my Naked Wine is delayed, or my Naked Wine came in like a crappy box, and the packaging was messed up. Or like you could actually see in the complaints, like, okay, like this has actually become an issue. And then it's, then you have to really think about that. Is it something that they can fix, right? Or is this something that is something to really worry about? And I certainly think about those things. And I'm not saying that I would be buying the stock at the current price, but I'm saying that when these short-term issues come to a head and people really do give you that buying opportunity, be prepared for it.
Absolutely. No, I'm glad. Listen, I'm glad we talked about Naked Wines a little bit, just because it's been such a cult name discussed on FinTwit. So that I haven't talked about it with anybody yet. So I'm glad we brought it up. So I have a number of other questions for you, but we're getting close here, and I definitely, we're going to be coming back on to talk about a whole host of other topics. But, I wanted to close it out with a couple questions that I ask all of our guests here. It's my favorite question to ask. What would you say is an investing experience that impacted you the most thus far in your career?
Yeah. Okay. I just got a flashback. So, look, in a lot of ways, I'm a self-taught investor. where I really learned how to invest, and I think I've mentioned this before, is when I was an investment banking analyst, I learned about Value Investors Club when I was like a first year analyst. And for like 3 or 4 years, I probably read like 90% of everything that was posted on there, right? I read every single pitch. And in some cases, I invested in some of them. I started following, I learned about Twitter, and I started following people like, John Huber, and reading his blog, and like some of these other people who like write really thoughtful things about investing. And so that was really, and then on top of that, like I've read all the, reading all of like the classic books that people who come on podcasts like this recommend. So that's like a lot of how I got my initial education. And then in addition to that, just like actually putting to practice some of that, right? And, I'm such a nerd, right? That when I was an investment banking analyst, on top of working, the ridiculous hours, when I had downtime, I would research my own stocks, and I'd put together like my own presentations and like pitch my stock ideas to like my managing directors and my VPs and my associates, and say, hey, like, what do you think? Is this a good idea? And, usually the first comment is, Luis, if you put this much effort into your actual job, you'd be way better. but then I'd usually get some other constructive comments, right? One particular situation that was actually really formative was I was investing in, I found a microcap. I think I read a pitch on VIC, which, can be dangerous when you're not as skilled of an investor, because, reading other people's pitches can be really influential, and it could create all sorts of bias into how you think about, the idea heading into it. The framing could be different. So I read a pitch. It was on a company called ARC Document Solutions, which I think is still a public company. I think it's probably still a microcap. And the idea was, this is a company that was like the leading provider of architectural blueprint documents. And they were like a printing company. When architects needed to print their documents for a construction project, they would, 8 out of 10 times, use ARC, right? And ARC had these, their moat was that they had these, and they probably still do. I haven't followed the company in years, but they had these printing sites basically in all of the major MSAs. And they're just really well known. They were just a go-to printer for these documents. These documents are technical documents. You need a certain type of printer. There's regulatory, in many cases, there's regulatory requirements that require you to print these documents. And I was like, okay, like this is a cash cow business, right? And then they had this new business that they were investing in, which was like a digital document business. And, they were trying to basically create this like cloud-based version of their physical business. And I was like, okay, this is actually really compelling, and the stock's cheap. It had like, I don't know, maybe like a 15% FCF yield. It had a founder who had like 20% of the stock. Check, and moat, like it's a small cap, nobody's heard of it. Like I was like, okay, like this is actually like really compelling. Like I got really excited. And one of the things I did, because I was really trying to put into practice all the things I was reading about in these books, is I called up a bunch of like architects in like different cities, and like just asked them, hey, like, have you heard of ARC Document Solutions? Do you use them? What do you think about them? And like pretty much all the architects that I spoke to said, oh yeah, like I've heard of ARC, I've used ARC, yeah, like familiar with them. And I asked them, oh, like, would you be like interested in like their digital solutions? And some people were like, oh, I didn't know they did that, or I guess I'd be interested in hearing the pitch. And I was like, okay, like I interpreted it all as like really positive, right? What ended up happening, at least in the time period that I was invested in, and I don't know what the company's doing now, but that physical document business really was more of a melting ice cube for various reasons, right? Just the idea of printing out documents is just steadily in decline, right? And a lot of those regulatory requirements that required physical documents, they were erased, and they were, and the new regulations in some areas, some places still have physical document printing requirements, but in a lot of places, they said, okay, digital is fine. In a lot of cases, digital is better because we could access it or do more with the files. And that digital business that ARK was trying to build never really materialized. And, you know, I learned a really early lesson about 2 or 3 different things there. First is I learned to be a lot more skeptical of like when other people pitch me ideas, and the importance of really doing your own work and like really trying to think through things, like think through all of like the negative, the downside cases and what could go wrong. You know, the second thing is I became really weary of, value traps, right? And actually, I went on to short a lot of value traps successfully after that, because I just realized that when a business is primarily staked in something that is in decline, and they're trying to pivot to something that's new, it's a really, really difficult transition, and most of the time it fails, right? And there's a lot of examples of that. And then the third thing that was really important in learning was, also just caution on doing proprietary calls, right? Like you have to have a really high sample size. You have to ask the right questions. You have to, just having like surface level calls with people and taking that. And there are also probably like leading questions that I was asking. And, I probably, the more appropriate question to ask is not, have you heard of ARK? Have you used them? Is how much are you printing today versus a year ago? Right. Or where like you're currently printing out documents. Do you think you'll still be printing out documents next year? Like those are probably better questions, right? Or another thing too is, are you paying, like, are you able to negotiate lower prices on the documents you're printing? Right. Like there's all sorts of questions like that. Right. And, the last thing too is like, did ARK really have a moat? Right. I don't know. Like I thought it maybe had a moat because it was the winner in a niche, but as it turns out, there's all sorts of other, local printers too. So, it really got me thinking about what does it mean to be a high quality business, and what does it mean to be a value trap? And there's some lessons that there's some mistakes that I've made again over, I've made some of those same mistakes again and again, but it's been really humbling every time I make those mistakes. and I think having gone through some of those like war stories, just personally has been a really good education, and it's been really formative.
So, by the way, thank you for that story. That was great. And I'm assuming you still don't own any ARK right now.
No, I took a loss.
You went to college, right? Or again, it was grad school. So, from that experience and from everything that you told me today, what would you say is the one or maybe the one lesson that maybe you'd want new investors to take away from this? I mean, I'd say the general theme of this pod was talking about merger arbitrage the most. So, and we don't really have any lessons kind of around that. So, I mean, what would you say is the number one lesson for those who maybe want to look at merger arbitrage as a potential investment vehicle?
Yeah, I mean, I think just like it's one lesson. I could think of a couple of lessons. I'd say like the theme of like my career trajectory thus far has been like I've had a very non-traditional route to getting to where I'm at, and I think the strategies that I found myself in are because of these are the strategies that like I'm personally interested in, and I personally have the right skill set to, whether it was because I was in something related to merger arb, so I got a special insight into this strategy, that's one aspect of it. But like I'm on the growth side, like I've just personally been interested in it for a long time, and I put in the work to, learn how to invest that way. And it's something that I am really passionate about. I'd say like the biggest thing, honestly, is just being really open-minded, and just be willing to change your mind. So I've been humbled so many times in the market. And I gave you an example of the time I was really humbled. I probably lost half of my money that I invested in on that situation. And so, sometimes you lose money and there isn't a really good lesson. You just got unlucky. Like some event just happened right? But sometimes there is a lesson. Maybe you made a valuation mistake, or maybe you misjudged the quality of a business. Maybe you misjudged the character of an operator, right? Maybe you didn't ask the right questions when you did a proprietary phone call, right? So just being really open-minded. I think that the nature of the market, it's a complex adaptive system, which means that, over time, the things that work aren't static, right? It used to be the case that you could just buy cheap stocks. You didn't really have to think as much about business quality, and you could outperform. And people have played with that data a bit. Like, I used to work at a quant fund. I've seen the data. Like, value used to more consistently outperform than it does now. And I think there's arguments to be made whether or not that's like cyclical or secular. But I would just say that, like, just being you always have to be learning. I think the techniques are constantly evolving. I've written a lot about things. When I wrote my year-end letter for last year, I wrote about the things that I learned, right, and the things that I'm now open to. When it comes to like valuation, like, I've become a lot more open to thinking about things on an EV to TAM basis, and just actually not necessarily putting my hat on an EV to TAM, but I think that's a really interesting data point for certain types of business models, right? And to think about how are ways that, like, the internet changing business models. And now what I'm really thinking about, I'd say the theme of what I've really been thinking about the last few months is how is like Web3 going to be different from Web2? And like, there's all sorts of interesting things happening in various industries where, you've seen crypto and blockchain potentially threaten some old ways of doing things. Like, one of the things I was reading about recently was that, Steam, the company that sells video games, is banning Web3 games because they're not able to collect their take rate if people are transacting in blockchain, right? And it's like, that's such like a nuanced secondary effect that you wouldn't think of right away when you think about what the implications of like what Web3 is. But it is important to like actually be open-minded and like try to learn about like what the new things are and how that might change your old mental frameworks.
Very good. All right. Well, Luis, with that, where can our audience go and follow you on social media, as well as get more information on LVS Advisory?
Yeah. So my website is lvsadvisory.com, and I'm on Twitter. It's Luis V Sanchez 777 on Twitter. And yeah, people can email me at luis@lvsadvisory.com. Happy to chat with people who found something I said interesting, or just, happy to always talk to people.
Very cool. Well, Luis, thank you so much for joining me today. I really do appreciate it. Good luck. Stay safe. And we'll definitely have you back on soon, either for this or on the roundtable to go over, anything. So again,
cool.
Thank you so much for joining me.
Maybe we could talk more about plants next time.
You know what? I think I'm going to have to do a plant episode coming up soon. But again, thank you so much for joining me, man. I really do appreciate it.
No, I enjoyed doing it. Thanks for having me.
Thank you. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.